Hey, good morning, everyone. Marty Missouri here, Friday, the 11th of August, 2023, with your economic update, your weekly update. And at the end, I'm going to run quickly through the daily charts of the S&P 500 and QQQ ETF tracks the NASDAQ 100 index. On the economic front, our index actually popped higher by 4 points this last week, and that's a nice bump to just under 13. 12.77 is our current overall score, which is a positive, and you can see the trend has been improving in terms of what it says about overall economic conditions. Still in that territory that says recession risk is high, but getting better. So as usual, I'm going to share a handful of the inputs, show you what's looking better, show you what still looks concerning, show you what maybe is getting a little worse, and again, then we'll finish up with a little bit on the stock market. Starting with mortgage purchase applications, that, as you can see here, continues to roll over. Now, granted, I believe the average 30-year mortgage is now north of 7%. But there's been a lot of talk, a lot of optimism, I think, in many circles around the housing market. It's not something we're losing sleep over. It is anomalous in a sense. We've talked about this before with the obvious fact that folks who might otherwise sell their homes, if they have a mortgage at, say, 3, 4, even less than 3%, they have no interest whatsoever in letting that go, buying a new house at twice the mortgage interest rate. It's interesting because it calls to mind a conversation I had with a friend here recently where the implication from the friend was that, when interest rates drop, that's going to be really good for house prices. And I get it, and that's intuitive. However, when you think about the dynamics under the market right now, a couple of things. One would just be also intuitive, and that is, well, if interest rates are dropping a bunch, that means the economy is not in such good shape, so that may not be great for home prices. But people are reluctant to buy because of these high mortgage rates. So indeed, lower interest rates by itself, all things equal, would increase the demand for housing. But thinking back to what I just said about the unique dynamic that we're dealing with today, it would also no doubt bring a lot of supply to market. So the question is, would heightened demand be met, not quite met, or more than met by supply? If it's more than met by supply, then that would actually be a headwind for housing prices. So we've said it over and over again, the dynamics of COVID will no doubt create some real distortions, time lags, things outside of what would otherwise be perhaps expected to be the norm. I'll use air quotes when it comes to the economy. So obviously what's going on in the housing market today to some extent reflects that, call it confusion or distortion around what went on around COVID. Consumer confidence is picking up. University of Michigan survey came out this morning, although it ticked back just a touch. Reading from that report, the overall index of consumer sentiment, as you can see here, is 71.2. Current economic conditions, 77.4. That's up from 76.6. However, expectations, 67.3, down from 68.3. So mixed for sure. Their long-term inflation expectations dropped down a tick. You saw the market react, or I saw the market react nicely to that news, and so we'll see. Initial jobless claims actually took a pretty big tick higher week over week. It was 227,000 last week, 248,000 this week. That's a pretty notable jump, and from my view, it still looks like the trend is higher. And folks, jobless claims and unemployment rate, you really want to be wary of those coming off of these levels, because historically, as we've illustrated, when they turn up, tends to be right just before recession hits. And so something to keep a very close eye on. Here's the Small Business Optimism Survey. Overall optimism ticked up to 91.9. Again, historically, it's not a super high mark, but it's a move in the right direction. Hiring plans ticked up just a little bit. What was really big was CapEx plans Capital expenditures, business expansion plans, according to the survey, ticked up to 27. Again, not historically super high, but a big move in the right direction, and that is that small businesses expect to be investing in themselves over the coming months. CPI came out yesterday. PPI, Producer Price Index, came out this morning. So the CPI, month over month, came in at just 0.2%. You can see that was the consensus expectation, and it was 0.2% in June. The year-over-year CPI, 3%. It was expected to be 3.3. We thought it would be that or a little higher based on base effects. Came in at 3.2. Market loved that for a moment anyway. The ex-food and energy, the core, and this is the sort of thing the Fed looks at, was at 0.2 prior. Consensus expectation was 0.2, came in at 0.2. Ex-food and energy year over year was expected to be 4.8, like last month, came in at 4.7. That was viewed overall, at least when it came out, as a positive by the markets. The PPI, or the Producer Price Index, month on month prior was only 0.1%. It was revised to flat. The consensus was 0.2, but the Producer Price Index went up 0.3% month on month, so that would be 3.6% annualized. Year over year, prior 0.1, revised up to 0.2. Consensus with 0.7, came in at 0.8. The core, ex-food and energy, was 0.1, revised into negative 0.1. The consensus was it would rise by 0.2, rose by 0.3. Year over year, core 2.4, consensus with 2.3, came in above consensus at 2.4. Ex-food and energy and trade services, 0.1 prior, consensus 0.2, came in at 0.2. And then the year over year, 2.6, consensus was 2.7, came in at 2.7. But overall, folks, the PPI came in hotter than expected. Market sold off as that news was delivered this morning because, it denotes that at the producer level, we could see a repercolating of inflation going forward. Raw industrial materials, this is also an input. We track copper, as you know, and the Bloomberg Commodity Index. This particular index is, as the name implies, raw materials, and these aren't traded in the futures market. So, one might argue that they may give you a more real-time look at what's going on in the commodity space and potentially in the commodities' immediate or near-term impact on inflation. So you can see that's been ticking up here of late. If you do a technical analysis the way we do it, you can see that the relative strength index has actually been giving us higher lows, as has the MACD, or the moving average convergence divergence. And these, as I've shown you a zillion times on the stock charts, this is actually a bullish chart. You have a falling wedge pattern with bullish divergences here on the momentum indicator. So that would suggest, technically speaking, that you could see a breakout of raw industrial materials, and that ultimately speaks to the potential for inflation here going forward. I want to show you this busy chart. Forgive me, but I'll draw lines so you can know what I'm looking at here. So this is the last month's sector to S&P 500 ratio. XLK is the tech ETF, the S&P sector tech ETF. 95.6 means that tech has been notably underperforming the S&P. 100 would be equal performance. Financials have caught a lift here at 102 over the past month. Consumer discretionary, though, at 97.5. Of course, discretionary companies are the ones that capture the consumer spending when they're feeling good about their future and they have extra money. So the action in that space, in those stocks, has been underperforming the broader market. Materials has been pretty much in line with the broader market. Energy stocks are up notably relative to the S&P 500. And again, you could argue that energy stocks are a reflection of the anticipation for energy prices, leads to potentially some inflation concerns. Industrials hanging in there just above, almost 101 relative to the S&P. But when we look at staples, 102, meaning they're outperforming the S&P, utilities aren't. Utilities are very interest rate sensitive, as are tech stocks. And healthcare is noticeably outperforming the S&P as well. So what we have here are some, if you look at areas, particularly like consumer discretionary, underperforming, and consumer staples outperforming, and healthcare outperforming, while the other ones, say for energy, are pretty much in line. That speaks to potentially the market anticipating a weaker economy going forward. And again, one read does not a trend make, but it is interesting to see the defensive start to make some gains here against what's going on. Now, when we take and do a ratio of consumer staples to consumer discretionary stocks, this isn't a bad economic indicator. This year has been a massive outperformance of discretionary over staples until just recently. You can see the staples are inching their way back up. Technically speaking, particularly right in here when we had a lower low and we had a higher low, technically this was a sign that we were about to begin to see staples outperformance. So again, this is short-term stuff. We won't put too much weight on it just yet, but it is something to keep an eye on that suggests that maybe the market is beginning to sniff out weaker economic conditions going forward. Okay, just quickly, the S&P 500. Remember last time we reintroduced the 20-day moving average because we broke down below it, retested it yesterday, and you can see that was resistance. Went up there and just fell hard right against it. Here's where we sit today so far. So I showed you here historically that rolling over, at least during this bear market, below the 20-day moving average has been a very ominous sign for something not necessarily small when it comes to the corrective phase. And you do see, like right in here, you see this chopping around. It's really when you've broken through, retested, and then the yellow line then begins to curve lower, is ultimately when you probably should expect that things are going to get worse before they get better. And there's nothing about the momentum that's encouraging here. We're not oversold yet. You would not get an oversold bounce necessarily from the S&P. There's no bullish divergences showing up here. So right now, at least on the daily chart, continues to look technically sour for the S&P in the near term going forward. And pretty much the same thing for the NASDAQ 100 index using the ETF here. You roll over off of that 20-day moving average and you tend to get some pretty big declines. What I did here, just for illustration purposes, is I measured the two most benign reactions to rolling over, and it was to this point, it was from the all-time peak, by the way, negative 7.64%. This one here early this year was a minus 9%. And if we get just to the best case scenario for this bear market, still have a pretty good drop here yet to go for the NASDAQ 100, even further in the second best case. And remember last time I said if we lose that 370, doesn't look like there's much protection. I mean, you could argue right in here, and we are bouncing up against that, but 360 would be your next maybe line in the sand to fight through if it is time for that next leg lower. And then, of course, on the momentum indicators like the S&P, nothing looks good here. In fact, not at all, and about to go below that zero line there on the MACD. And when you cut through that, it just tends to confirm what's happening in the price action to the downside. So yeah, good time to I think play some defense, stay very, very diversified. Probably hedge if you can with some options as well, which is what we're doing here on behalf of our clients at PWA. And I will leave it there. Hope you all have a wonderful weekend, and I'll talk to you next week. Take care. Bye-bye.